discussion which is on impairment of financial assets. Friends, the very idea of this topic is to look at how do we identify when the impairment, when is the impairment testing done for financial assets, and of course also looking at another question as to what types of financial assets are subject to impairment testing. So there are two questions that we need to address. One is, when is the impairment testing done for a financial asset? As to what is the time? Is it at the time of the reporting date? Is it at the time of, let's say, a trigger or an event taking place? For example, there is a likelihood that a customer may default just because he has met some losses. So at that point in time, or are we looking at the time of initial recognition? So this particular standard specifically talks about that timing of the recognition of impairment loss, and of course it talks about what types of financial assets are actually subject to impairment testing. What we need to kind of remember here is, as far as answering the second question is concerned, we would like to focus upon the very basic thought process of how are financial assets classified. What is the classification for financial assets? Guys, we remember there are three categories, predominantly fair value, through P&L, fair value through OCI, and amortized cost. So when I look at an example of fair value through P&L, I'm probably talking about financial assets where I'm doing some trading or speculation, or maybe I'm looking at some equity instruments which are shown at fair value, right? So fair value through P&L precisely. The fair value through OCI, this category would normally comprise of, let's say, bonds which are likely to be sold before maturity. And here, when I look at amortized cost, precisely we said we are talking about two conditions. One is the business model talks about the recovery of contractual cash flows, right? Plus, there we said recovery of interest and the principal part of it, right? So that is where we look at this very criterion of the amortized cost. The standard clearly provides that if you are showing some financial assets under this particular category, that is the fair value through P&L, there is no impairment testing required to be done, since every change will be taken to the P&L necessarily, right? So this first category, where we have financial assets shown through P&L, that is FVTPL, we do not need to do any impairment testing since every change is always taken to the P&L. However, on these two categories, the fair value through OCI and the financial assets shown through amortized cost, we do test these financial assets for impairment, right? And categorically our focus today will be on this category, as it requires a detailed understanding of how should impairment testing be done to such kind of an asset, such kind of financial assets, how it should be done, why is it being done, and when is that being done. So our focus would precisely move towards this particular category as far as today's discussion is concerned, where we look at impairment of financial assets shown under or shown through amortized cost, right? So let us talk about this briefly in terms of what is the idea of a financial asset shown through or shown under amortized cost. We said that we have already talked about it as to the very objective, that is the very idea or the business model of the entity holding such an asset is towards recovery of contractual cash flows that is arising on specific dates. So let us say, for example, a bank giving a 20 years housing loan, right? A bank giving 20 years housing loan, 3 years car loan, etc., right? So you're looking at that the EMIs, for example, recovered by the bank would arise on the specific dates as per the agreement or as per the contract. Plus, we are talking about the repayments indicate or suggest something called as SPPI, which is solely payments of principal plus interest, right? So that is something which is the prerequisite. These two conditions, condition 1 and condition 2, these must be met, wherein we talk about an asset to be shown through amortized cost, right? Now, having said that, once we have identified a financial asset at amortized cost, it's time for us to identify, it's time for us to recognize as to when the amortized cost financial asset will be impaired. When will the provision for the impairment loss created for such kind of financial assets which are shown at their amortized cost, right? So what we are saying here is, let's talk about an instance here. There is a company X that gives, let's say, advance to company Y. Okay, so we have company X that gives advance to company Y. Let us say this is $100,000. Okay, the term of this loan is, let's say the tenure is 5 years. Let's even understand basically, since company X is giving some money to company Y, it might as well be charging some, interest from company Y. So let us say that if there is a risk-free rate of, let's say, 5%, as in, when I say risk-free rate, it could be probably some investment in government bonds, sovereign bonds, etc., as we call them. Although we are not saying that this is entirely or absolutely risk-free, because even countries, have defaulted in the past. But for the sake of assumption, let us say that if government bonds are riskless bonds, of course, giving some money to another institution, another company, for that matter, even a bank can be riskier. So, when this investment is riskier as compared to a government bond, of course, company X would expect a higher return, that is greater than 5%, because without risk, if you can invest into a bond which gives you at least 5% with an amount of a risk, let us say we are talking about a credit risk, of course your expectations as an investor will be higher than what you receive probably without any risk. So let us say that the return, that is your interest income, as per the contract is 7%, right? So what we are saying here is there is a risk return of 5% and your return is 7%, which means that your interest, that is the return or yield, right, that is something which is going to be the focus. It automatically tries to compensate, or let's say company X interest, that is the return or yield, tries to compensate company X for the risk of default likely to be made by company Y, right? That is something which is the key point here, that you would have received 5% without taking any risk, but if you are investing into any company, any kind of investments wherein there exists a credit risk, that is a risk of default, you would want to compensate yourself for that risk taken by charging something extra over and above the risk-free return. And that is where we say that this yield, this return, this interest income already includes a possibility of an expected credit loss. You already are aware while giving the money to another company that yes, there is a likely risk, and that is where you want to charge a higher interest, and that is where we say you are aware that there may be an expected loss coming in, and that is where my standard says this expected loss must be recognized at the time of the recognition of the financial asset. The moment you have entered into an agreement to make an investment into the other entity, you need to create this impairment loss provision for that expected credit loss, for that expected risk of default, for that expected credit risk, for that expected probability of default. No matter what you name it, that is something that you are supposed to provide for. And the very basic principle is the Prudence Concept, right? So what this accounting standard is trying to say, it is saying that earlier when people, banks, institutions used to make advances to other companies, institutions or banks, they would wait for the recognition of an impairment or a probable loss. So earlier, such losses were accounted for on an incurred loss model. A bank giving loan to an individual, or a bank giving loan to many such individuals, let us say against a property, right? There is always a risk that the value of the property may decline significantly against the value of the loan, which means that tomorrow if the loan amount is higher and the value of the property is lower, there is always a chance that the borrower may stop making the payment for the loan, because he knows that even if it does not make the payment for the loan, the bank most likely is going to acquire the property against which the loan is given. And of course, the value of the property is so low that even if he does not pay the loan and hands over the property, he still gets a benefit, or the lender, the banking company, ends up into a loss, right? This kind of a loss was always known to banks when they were, of course, making such kind of an advance. But then the earlier standards said that you would wait for that event to take place. You would wait for something called as an occurrence of an event happening, that is an incurred loss model, which suggested that the provision for loss was always made too late and too little. You would not be willing to provide for the loss until that event took place, which was too late, and many a times you would only provide for a loss which eventually is probably gonna increase exponentially. Therefore, in terms of the quantity also, in terms of the value also, the loss provision was too little in amount, right? So what we are saying here is, such kind of delayed recognition of losses allowed, so my earlier accounting treatment permitted, or let's say allowed, entities, that is the lenders, to delay the recognition of losses, right? And that is where you started wondering in terms of how should the impairment of financial assets be done, specifically for the financial assets taken at amortized cost, as to when should it happen. We are saying the current requirements want the recognition of such losses on day one itself, right? The current requirements, the new accounting standards suggests that such kind of losses need to be recognized on day one itself, right? So when I say that I'm looking at such kind of impairment losses to be recognized, we suggest that here we split the financial assets impairment loss again into two categories, right? The first is 12-month expected loss, right? And the second one is lifetime expected loss. Two categories we are saying. The impairment losses for such kind of financial assets could be divided into two categories. One is a 12-month expected loss and the second one is lifetime expected loss. The name itself suggests, when I look at a 12 months expected loss, I'm talking about any probable loss likely to happen within next 12 months, right? So when I'm trying to recognize such kind of losses on day one itself, my first stage, my first step would be to first measure, are there any probable losses which may take place within the next 12 months. That's where you define these 12 months expected losses. And my step 2 or my stage 2 talks about, are there any lifetime expected losses, right? So you're given some money to a customer, maybe to a borrower. The term is 5 years. So over these 5 years, what is the expected loss that you see over the duration? That is something which is defined as a lifetime expected loss, right? So gonna spend a lot of time understanding these 2 points as well, in terms of what do they mean, how do they apply, and when would these be, and how would these be measured, right? Let us say I'm talking about a scenario where I have company X grants loan to company Y amounting to $100,000, right? Company X considers that company Y may default within next 12 months. Company X, at the time of giving this money to company Y, assumes that, well, yes, company Y may default, and the expected loss may be 20% of the principal, right? So company X thinks that, well, within next 12 months, it may so happen that the company Y, which has taken this $100,000 from me, it may default to the extent of $20,000, which is 20% of 100,000. And the probability, likelihood of such an event is, let's say, 2%. The probability of such an event is 2%. Now, if I were to calculate what is my 12 months expected loss in this case, it can simply be calculated that the amount under the exposure or the amount under the risk multiplied by the amount which may get defaulted, the amount which may not be recovered, multiplied by the probability of default, right? So this amount comes to 4%, which is of course $4,000, right? This $4,000 denotes what? This amount denotes the 12 months expected loss which company X needs to recognize when it has given the amount to company Y, right? So if I look at the accounting part of it, we are saying on day one, debit investment $100,000, credit bank, and at the same time day one, debit impairment loss, which is $4,000, and okay, I hope I'm doing the right calculation. $100,000 into 20% to 20,000. 20,000 into 2% becomes 400. So just need to rectify this. This is $400. So impairment loss will be 400 credit provision for impairment loss, right? Precisely, that's another important distinction that we want to make here is that in such case you are not saying that your asset or that your financial asset has been impaired. You are rather saying it like this, that you would continue to show your financial asset at its originated first day one value, and simultaneously you will create a separate provision for an impairment loss. That is where you try to distinguish between impairment for other assets versus impairment of, let's say, a financial asset, right? So what we are saying here is precisely you will create a provision separately apart from showing the investment at its original cost, right? How much effectively have you paid is $100,000. Of course, the interest income, so let us say this money is received, credit interest income, it will be shown at, we haven't really mentioned the interest rates here. So let us say the interest rate is loan at the rate of 6%. So let's say interest rate is 6% on $100,000. You will show $6,000 as your realized income, right? So that is one important distinction as far as doing the accounting for such kind of investments is concerned. Please bear it in mind that such kind of investment directly impacts each and every kind of an organization. Any entity, be it a company, be it an individual, be it a banking institution, being an insurance company, whatsoever, whatever investments that you have made, which you are showing at amortized cost, would necessarily require you to create a provision, right? Because that is where you look at it. If you are giving money to somebody, you cannot say that there is no risk of a default. So such measurement has to be done for majority of financial assets, right? My standard gives me an exception to this 12 months expected loss for any trade receivables, contract assets, for that matter, lease amount receivables. My standard suggests that if I'm looking at a trade receivable or any contract asset arising from the requirements under the revenue accounting standard, that is the revenue from contracts with the customers, and the lease receivables under the lease accounting standard, for such kind of financial assets, we do not use the 12 months expected loss criterion. What we are saying is, we are using something called as a simplified approach for such kind of financial assets. I think one of the considerations that the preparers of this accounting standard suggested is that if you look at a banking company or an insurance company, they would have all the tools, all the techniques, very advanced models to even measure, let's say, 12 months expected losses for any kind of investments, any kind of financial assets that they have invested into. Howsoever, in the normal course of business, any other kind of businesses, of course, something or some entity which is not a banking company nor an insurance company, would find it very difficult, practically a huge challenge, to measure what is the likely expected loss, 12 months expected loss for, let's say, a trade receivable, maybe a contract asset or a lease amount receivable. And that is where they have given a very simplified approach that for such kind of assets, the 12 months expected losses not permitted. Of course, there are some detailed rules around the contract assets and the lease amount receivables, but as of now, we don't want to talk about that. Such kind of assets would need to be impaired or would need to be tested for impairment when we look at the measurement of lifetime expected losses, right? So that is something which is quite a detailed standard all of a sudden, where you look at a lot more information, lot more accounting around both these elements in terms of what is, let's say, a 12 months expected loss and what is, let us say, a lifetime expected loss, right? So there are a lot of examples that we need to cover, that we need to discuss to understand the very idea of impairment of financial assets. The very thought process behind this principle is the Prudence Concept, which talks about any expected future events, they need to be brought into consideration at the time of the recognition of a financial asset. So quite a detailed, quite a comprehensive accounting standard with a clear direct impact on both the profitability of a company and also the financial position. Imagine you are creating a liability, you are creating a loss, straight away implications on the financial position as well as the financial performance of an entity, right? So that is something that we wanted to cover in today's discussion so far. We will be discussing it more in detail with the following set of sections. Until then, have a good day and good luck. All the best.